and welcome. I'm Kavita Thapliyal, and it's time to kick off National Nutrition Week on the Money Show. And today onwards, we begin the entire week, which is full of nutrition for your investment and your investment portfolio. And our very first edition, which is on today's show, we'll be talking about a nutritious thali. Yes, so all those folks following a fat diet, beware. This is going to be a healthy dose, or even better, one healthy diet to keep up with the nutrition for your wallet. Just like in a thali, we have different food groups in the form of carbs, protein, etc. This investment thali will also have various asset classes or the right mix of assets or investment instruments, especially for you. So let's get on with our first edition of Nutrition Week, and let me also welcome our guest on the show who will be talking about nutrition for your portfolio and nutrition for your wallet. Let's welcome Himadri Chatterjee, Head of Advisory and Key Clients Group 361 Wealth. Himadri, good evening and welcome to this power pack and a very healthy show, if I can call it that. So we will definitely, go into the nitty-gritties, and we'll be talking about the thali, etc. But let me begin with knowing your dose of nutrition. If I have to ask you your favorite type of thali, which is full of right kind of nutrition, in terms of food and investments, Himadri, both fronts I'm talking about, what would that be?
Thank you, Kavita, and thanks for having me on. Well, just like balanced thali should have a mixture of proteins, carbohydrates, fats, vitamins. Similarly, for a portfolio, I think having the right diversification between equities, fixed income, real assets, commodities, cash is extremely important. Just like we put food on our plate, then we ingest the food to get the nutrition. Similarly, you take various asset classes, put them in the portfolio, and they have different income streams, different long-term behaviors, which give stability to our portfolio and lead to a nutritious diet. So one can, for example, to try and draw an analogy, you can think of equity, long-term equity, as the protein in your portfolio. Just like protein makes you stronger for growth, builds muscle, makes you stronger in the long term, equity is an asset class which is meant for long-term compounding capital growth. And so that forms really the core of a nutritious diet for your portfolio. You can think of fixed income maybe as carbs in the portfolio, which is carbs give us a steady supply of energy so that we don't crash during the day. Similarly, fixed income in our portfolio gives you a steady supply of coupons, regular interest, and it ensures that your portfolio never crashes if equity markets, for example, were to be a little volatile.
That's very interesting. So Himadri is very interesting, because earlier I was of the mindset that you might want to call equity as carbs and something else as protein, but equity as protein, definitely no. What is the reason behind selecting equity for protein?
Yeah. So proteins, you've heard of muscle memory, okay? You've heard of how you can become a different person if you just do a little weight exercise, eat right. Similarly, how do you make your portfolio strong for the long term? Okay, how do you ensure that it protects you against inflation? How do you ensure that over long periods of time your portfolio is stronger than what it is now? The only real strategic asset class which can lead to significant compounding over inflation over long periods of time is equity. And so really it has to be the only asset class which you might think of as protein and not as carbs. Carbs, you need a steady supply of carbs. You're burning that glucose every year. So that probably, I think, is a little more attuned towards the characteristics of fixed income, and probably some fixed income alternatives maybe REITs could come in a small fashion to fill up that space.
Pretty interesting. So, equity, protein, and fixed income is carbs. I'm also joined by Feroz Aziz, Deputy CEO, Anand Rathi Wealth. Feroz, good evening and welcome to the show. We're already in discussion with Himadri on having a nutrition for your portfolio. I also want to start with asking the same question that I did to Himadri. What's the kind of nutrition for your health that you are following now and for the health of your portfolio? Feroz.
Yes, so I think the mantra in both the cases is balance, santulan, as we call it in Hindi. A balance is very critical. There are some things which, on a portfolio side, I'm allergic to, which is pure debt sometimes. I'm very allergic to because for long-term goals. So apart from some allergies, I would say it's a very balanced diet is what is my mantra on both the sides, on the portfolio side and also on the health side. I have done my mistakes. I have been very protein heavy on the nutrition side, and I've had my learnings in the form of 1-2 years of only eating protein, resulted in a lot of kidney problems for me. But I was optically looking great. I had lost weight. I was ऊपर से मैं बड़ा अच्छा लग रहा था, but then when I got my tests done, then there was enough for me to correct. So balance is the mantra. And that's what, after a lot of rap on the knuckles, I've learned that balance is not compromisable.
Exactly, and the same should be applied for our viewers also in their entire investment portfolio. But then let's see the discussion ahead. And Himadri, so we are done with protein and carbs. Other items, what do you think they represent the kind of asset class?
Sure. So, for example, vitamins and minerals, you need them in small doses, right, to ensure the optimum operation of your body and your well-being. So, I think that portion is filled by real assets, commodities, and to some extent, even cash as a short-term parking asset class. For example, let's look at financialized real assets. If you talk about REITs, for example, not only are they providing diversification, like my fellow panelists spoke about balance, but they also provide yield or cash flow. So there is not only diversification in terms of the stock of your portfolio, which is asset classes, but also income streams that come in from that portfolio. So that element is very important. Gold, for example, is generally seen as a hedge against inflation, against the dollar, and all the flows that are associated with it. So again, in smaller portions, they create the fine tuning of the balance that you want vitamins and minerals to do for your body, and they provide it in the portfolio.
All right, but now the question arises, Feroz, you might want to answer this. Market conditions are never the same, okay? And talking about the items in a thali, how do we decide what's the right proportion or what's the right portion for us? We always tell people to invest more when the markets are down. Does that mean that, you should also be eating more if you're more hungry? What happens is, you really don't want to mess up with your health. And similarly, talking about your portfolio health and the kind of investment instruments you're talking about involved in diversification and your portfolio also overall, what's the right amount of portion? And on what factors can you also decide that?
Yes, Kavita, see, I think, like you said, times are not same, right? Similarly, when it comes to food, times are not same, right? I don't eat for breakfast a pizza, right? In fact, I don't eat one any time. But I'm making a point that there are different things you eat at different times. You would not have a heavy meal, ideally, if you wish to be correct. You would not have a very heavy dinner, right? Because you don't have the need of such energies to sleep, right? So point one is there has to be a different time resulting in different kind of a portfolio composition. Time could be external factor, but I personally think internal factor from a time perspective is even more critical. If you're a youngster, then I would say that you're still in the bright 11 o'clock in the morning, right? So you have the capacity you need another 8, 10 hours of energy. So I would have more equity, right? But if you are in the fag end of life, maybe at the age of 80, would you want to, for your consumption monies, take the risk which a 30-year-old would want to take? For your intergenerational wealth, what you're going to give to your grandchild, you can still have equity. No, that's one thing which is very critical. So time is very critical. Second, when it comes to anybody in nutrition, they've always told me that you should eat. One Miss Devakar, of course, a very popular nutritionist. She assisted one of my senior colleague, and she said that you eat smaller portions, eat everything which grows around you. Don't eat something from New Zealand. Your body is also not accustomed to eat something from somewhere else. So point is, do you want to go get crypto for yourself? May not be. Whatever is grown, homegrown, is something which is more healthier, both on the portfolio side and your nutrition side. The second is systematic investment plans, for example. She says, have 8 different meals of smaller portions, but in a more disciplined fashion. So discipline, eat what you understand, what is next to you, rather than just go with the attractiveness of eating a kiwi which doesn't grow here, just to sound fancy. Maybe those are things which I think resonated very well with the investment thought process as well.
Things that sound investment that sound fancy, or also investments that are in trend. And within asset classes also, just like for example rice, Himadri, we've got white rice, we've got specialized rice, we've got black rice also, we're supposed to be very healthy now. Similarly, when you talk about equity, people are investing across market caps, people are investing via mutual funds, they are doing it via direct stocks. How can one decide this particular exposure?
That's a great question. Since we're talking about equity and proteins, I'm not going to talk about rice, but I'm going to talk about proteins. So just like in proteins, you can have vegetarian hai, so you can have tofu, you can have legumes, non-veg hai, you can have fish, you can have chicken, and you can have red meat, right? Similarly, in equities, there are 7 or 8 ways to create this balanced thali within equities at the sub-asset class level. So you can have index funds, you can have ETFs, you can have actively managed mutual funds, you can have PMS, you can have AIF, you can have unlisted equity, and you can have international. So let's say 7 ways to invest in equity. And then you think about, hey, what do I want to really balance? So I want omega-3 fatty acids, so मैं थोड़ा fish खा लूँगा. I want like the best taste, so I'll have a little bit of red meat. Similarly, if I want to really gun for the most most potential compounding, okay, then I should have some unlisted equity, okay. But that might cause me a little bit of indigestion because उसमें liquidity नहीं है, उसमें lockup है, उसमें there is a little bit more concentration, very difficult to analyze the underlying companies, etc. And if you are able to balance these together and you say, hey, how much liquidity do I need in my portfolio? All right. How much do I want to target participating in equity versus outperforming the broad market? All right. So what is a greater priority for me? How much do I need my portfolio to be relatively lower cost? Okay. With the balance saying that I might not outperform markets very well. So that creates the opportunity for a little more passive exposure. I want to allocate capital outside India because there might be businesses which are not available in India. I can't buy deep AI in India today. I can't buy aerospace in India today. So how do I allocate to these industries and bring that element of bring that element of nutrition in my investment thali? So that really informs the choice between these 7 sub asset classes within equity that I spoke about.
Right. To me also, it sounded like adding masala or making your thali more chatpata. But then what else can we do, on these lines? And what about crypto, and what about FNO and these kind of risky strategies that investors are also taking up these days? Let's also discuss this as a part of your nutrition and how healthy or not healthy it is. But it's time for a quick break, and post that we'll be talking about making your investment thali more chatpata, and also depending on market movements, what should be the exposure in each asset classes, and how you should be careful about not going overboard in any of these, and making it more riskier for you. All right, so it's the National Nutrition Week on the Money Show, and we're talking about nutrition for your wallet. And today I have Himadri Chatterjee from 361 Wealth and Feroz Aziz from Anand Rathi Wealth. Welcome back. And Feroz, now I'll come to you because you need to help us understand the chatpata element in our thali of investments. Now, how to go ahead with that?
Yes, when it comes to the chatpata element, I would say you have to be careful of what chatpata can you take and what you can't. For example, I would say gold is the chatpata item. Of course, so conventional that you would want to not call it the chatpata. I would call gold as the chatpata item. Of course, like garam masala, it goes with the color of gold. And when it comes to several other chatpata things, I have realized in my own portfolio, they actually create more damage. They sound very fancy, but they create damage. For example, like Ajinomoto, right? Might enhance the taste extensively, but may not be the right thing to do to add to your portfolio. So that's point one. Point two, you look at what is the thing which is fair. Now, for example, like you said, InvITs and REITs, like Himadri also said, those I would consider as instruments which are catering to a specific taste and a need. That's why they are the pickles and the masalas and the chatpata items of the thali, I would like to believe.
All right. Let's talk about having the right kind of exposure, Himadri. Now, we've talking about various asset classes and also the right kind of nutrition they provide to your financial life. But then how do we decide the right portion or exposure age-wise?
Yeah, I mean, it's an interesting question. When you're young, you're a little more active. Like I used to run marathons at a point in time. So I had to load up on a lot of proteins. Okay. And the day before the marathon, I had to load up on carbs. So just because I was young didn't mean that I couldn't take one food item or completely let go of another food item. So even there, it's about balance. Similarly, I think Feroz alluded to this earlier. If you're young, you have time. I think he used time as a variable. You want to be able to participate in the compounding over a long period of time, and so potentially a slightly equity heavy investment thali. As you're getting on, you want to plan a little more for achievement of the life goals, and so you want a little more stability in your portfolio. So in your life, you might move on to a little more carb dense or protein dense diets. You might want to low calorie because you're not burning around out so much. So then in the investment portfolio, you might say that, hey, listen, let's move over to a more balanced portfolio. Let's get some income generating assets into my mix. So let me start looking at potentially REITs. Let's get some balanced funds into the portfolio. And so really the emphasis changes from targeting high growth and living with the volatility and sort of being able to ride out the volatility. The balance changes or the focus changes, I'm sorry, towards balance. And towards saying that, hey, listen, I still want to beat inflation, but I now want to keep an eye towards achieving my financial goals, and therefore being able to just draw back a little in terms of the overall risk in the portfolio.
Feroz, since we are talking about nutrition, and we really cannot skip the fact that people follow trendy diets, just like how people follow all the noise that they, hear around. Maybe it is social media, or they just hear it from their friends. What works for other people, they think that it works for them also. So just how it is the case in your diet. People follow keto, which is a very protein-based diet. They have different, maybe an intermittent fasting, etc. So talking about in financial planning sense, what are these fat diets or fat strategies according to you, which one should try and avoid as much as I can, and even if you want to follow one, see to it what suits you?
Okay, Kavita, you're absolutely right. There is actually, the more we discuss, it's getting clear in my mind that they are actually correlated variables, health and wealth. Both are very, very correlated variables. As far as I understand, when you go to a nutritionist, and the reason you go to a nutritionist is you can only get ground rules from books, both for investments and for to know what's right food. You will only get the foundation elements. But imarat aapko specifically banani hogi. So it's very important to get specific, and specific, sometimes you might need somebody to understand your current situation and then tailor make, as per your blood reports and your allergies, the exact specific diet for you. Second, what are the implications of not having a balanced diet? Like you said, keto. And I have followed keto, and I could understand the impact it had on my body, and that was very detrimental. I would say that sometimes the side effects are greater than the main effect, and when you superimpose a side effect, it could be life-threatening. Now, let me give you two examples of not having a balance. There are several clients who sometimes get very carried away, especially in the current situation where you see 60% return on the broader market over the last year and a half. People get carried away and say, why not have all the money in equity? When you do that, when the tide turns, is when you know who's swimming naked. So what happens is several long-term investors become short-term investors. If you look at post-COVID era, which is FY21, FY21 was a year when Nifty averaged at 11,000, which was a great level to enter, but 1,25,000 crores of equity mutual fund assets went out from HNIs, apart from the SIP money, on a base of 6 lakh crores. That means 20% of the money was redeemed, which meant that if you are equity heavy, this is not even 100%. If people go 100%, I've seen people cry in 2008 and exit at the wrong time. So that's one. The second example I would want to give is something which is very dear to my heart. And I spent 2 hours debating with my cousin who I lost, who was 32, and he had 97% of his wealth in real estate. I debated extensively. Unfortunately, a year after my extensive debate, he was diagnosed with pancreatic cancer. Okay, and his dad was running helter-skelter to sell his properties so that he can go to MD Anderson, which is there in Texas actually, for a treatment, and he needed 9 crores. The money was not available on a click of a button. So liquidity is meaningless. Illiquidity is something which completely defies logic. If you don't have half your money on a click of a button, then you're not wealthy. You might have whatever net worth, but not wealthy. So anything in a balance is very critical. I just thought India is real estate heavy, and you will find several people who own one Rolls Royce and 100 crores of real estate.
Sure. All right, I think great takeaways on the show today. My time is up, but then we definitely have many more aspects to be covered on this particular front. But then thank you so much, Himadri and Feroz, for taking time out and helping our viewers and giving them all the right strategies to keep their wallet healthy. Thank you so much. And on that note, it's a wrap. Thank you so much for watching. Goodbye.
If you like this video, then like, share and subscribe to ET Now.